Now, what does all this mean in terms of valuation now? End of the day, the easiest metric to look at is a price to earnings multiple. Now, there are flaws in every metric that you look at, but let's just take this as a metric which is simple to understand for anyone and everyone who's looking at the market. So as you can see, the historical PE in terms of how Nifty has moved over the last 10 plus years, we are slightly over mean, but at the same time, we are well below the peak that we saw between July and October of 21. Now, it's important to understand that this historical measure is backward looking in nature, and it has two variables. One, how is your earnings growth going to change from here? And second, how are your companies going to show that growth in terms of incrementally allocating capital? And that is the reason there is always going to be variability in valuations. But if you assume that India is going to grow GDP plus inflation over the next 1 year, which is going into FY24, in terms of so-called market multiples, we are not expensive. Now, the same thing, if you look at it from a price to book perspective. Now, why is price to book important, especially when you look at Nifty? See, end of the day, Nifty is a very unique index where 45% of the index is financials as we speak. Now, in the next few slides, I'll explain to you that financials, the wrong metric to look at financials is price to earnings, because end of the day, from a financials perspective, it's always you look at a book value. Today, if you look at HDFC banks or ICICI banks PE metric, it will be between 16 and 17. That's not the right metric to look at from a PE perspective. What you want to look at is how is the book value of a financial growing, and you give a multiple on that. And hence, when 45% of your index is skewed to a sector where price to book is a better metric, it obviously does make sense for you to look at that metric in tandem with price to earnings, because price to earnings does not give you the full perspective. Even if you look at it from a price to book perspective, while we are above a historical mean, we are well below what you saw the peak in terms of 1.5 years back. Put another way, your July to September peak in terms of price, the valuations have not got there, but Nifty hitting a new high means the earnings expansion has been leading to that. So considering the index from a PE or a price to book perspective, outright index valuation does not look expensive yet, as far as we are concerned. Now, the same thing is also explained through what we call a return on equity, which is again a backward looking measure, but it explains the fact that this new high that the market has hit has predominantly been on the back of strong earnings. So it's not that flows have driven this. It's not that multiple re-rating has driven it yet. It's earnings growth that has driven it in the last 1.5 years, which is always a healthy sign.